Audio Jungle.
Today we discuss the rigging of the world economy by central banks with author Nomi Prins.
If you can manufacture, and the current tally today is $21 trillion of money that has bought assets that sits on the books of the major central banks in this world, that is a lot of money that could be used as collateral for loans to actually do stuff, or even in and of itself as cash, where it's collateralized by the assets that they bought and they hold on their books, to do a lot of good in the world. And instead, what it's done is it's pumped up markets. So when you start to implode backwards, all of that unravels very quickly.
The financial crisis of 2007 and 2008 saw central banks inject trillions of dollars of fabricated money into the global financial system. This flood of money created trillions of debt. The global level of debt is now an estimated $325 trillion, more than 3 times global GDP. Banks have hoarded this money or used it to buy back stock, fueling the stock market, and funding extravagant salaries and bonuses. To pay for this debt, ordinary citizens are being bled with programs of austerity, stagnant wages, rising prices, and debt peonage. The system is inherently unstable, and when it goes into shock, these banks have created a system where there will be no way out. Today we discuss the hijacking of the global economy by banks and financial institutions with author Nomi Prins. So in your book, you begin with the financial crisis of 2007 and 2008, and you write that that crisis converted central bankers into a new class of power brokers. What do you mean by that?
Well, before the crisis, they were just asleep at the wheel, and particularly the Federal Reserve in the United States, which is supposed to be the main regulator of the major banks in the United States, and did a horrible job of doing that, which is why we had the financial crisis. They became a deregulator instead of a regulator. But in the wake of the financial crisis, their solution to fixing the crisis and saving the economy from a Great Depression or recession or whatever the terminology was used at any given time was to fabricate trillions and trillions of dollars out of sort of an electronic ether and provide it to...
Is that kind of what Marx calls fictitious capital? Is that...
Yeah, or in today's terms, we could call it fake money, but it is.
This is the central theme of the book.
Yes. Yes.
Define what fake money is.
So effectively, to define fake, you have to consider real. Real is real is money that has been created because of work, because of goods sold, because of services rendered, because of things that are actually touchable and feelable and actually happened. From the standpoint of central banks, there's an electronic process by which they can create, literally out of nowhere, certain amounts of money.
This is what the Fed does.
Which is what the Fed does and other central banks, the European Central Bank, Bank of Japan, and so forth. The Federal Reserve started this process in the last 10 years of the financial crisis to create a massive amount and create from nowhere, create electronically.
Trillions of dollars.
Trillions of dollars, and provide it to the banks that were hobbling under the weight of their own crimes. And the idea was that if they didn't receive a bailout from Washington and a tremendous subsidy over the years from the Federal Reserve and other central banks, that the entire system would collapse, the economy would collapse, people wouldn't get their money out of banks, and so forth. So they screw up the system by virtue of a lot of fraud and a lot of complex subterfuge in financial asset creation and proliferation, and then they say, we need this help. The Federal Reserve, as the lender of last resort, and with an emergency clause in the Federal Reserve Act of 1913, which allows them to help provide liquidity, provide money to the banking system when it needs it, went into overdrive and fabricated not a few $100 billion here or there, which itself would have been a lot of money, more than it's done ever before, but trillions and trillions of dollars. Right now, it still has on offer $4.5 trillion on its books, but at times it was far greater than that.
Which they lend at virtually 0% interest.
That's correct. So what they do is two things, and the whole idea of a 0% interest policy, or ZIRP, or a negative interest rate policy,
isn't it technically like 0.1%?
Yes, there's a balance.
Right.
They've hiked rates a little bit since 2015, but predominantly they cut rates to zero, which meant that their members, the private banks, could access money at no interest. And not only that, they could use this no interest to buy treasury bonds, give them back to the Fed, and receive 1/4 point interest from the Fed. So not only were they getting money effectively free, they were also getting interest for buying bonds with that money, which is one of the activities, only one that they did with that money, and giving it back to the Fed because this was considered an emergency crisis-related activity. Now, that still is in effect today.
But as you point out, it's become the new normal, I think is the term you use.
That's right. So TARP, actually, which was known as the bailout, $700 billion, which was given by the government, also had a little clause in it that enabled the Fed to give 1/4% interest. And this is just a small part of the story, but two private banks for effectively using the Fed's money to buy bonds and give them back to the Fed and get interest on that. So the banks are already starting the game with more interest from the Fed and cheap money from the Fed than people are getting in their savings accounts from day one of the financial crisis. And this exists to this day. For the most part, people aren't getting very much interest to almost no interest if you count the cost of opening an account and the fees that these big banks render on people. They're effectively paying banks to keep their money, whereas banks are getting money free and getting paid by the Fed to use it. And that's, again, just one of the elements of the way in which
we'll just throw in there that, of course, the Fed also bought up their toxic garbage.
That's right. So $1.5 trillion of the $4.5 trillion that is still available from the Federal Reserve that was created to liquefy the U.S. banks was in toxic assets, was in mortgage assets that nobody wanted at the time. And the idea was
these are subprime mortgages that everybody knows will never be repaid.
Well, and not only that, it's subprime mortgages packaged and repackaged and used all sorts of ways in these securities that not only will they not be repaid, but that at the time were worth far less than what the Fed paid for them. So again, it's like going into somebody's old garage sale and saying, I want that bicycle with no wheels, and you know what, I'll just pay you $100 grand for it. Right. Why? Because it's not my money. And that's what the Fed did. That money doesn't come from the Fed. The banks have to provide a certain amount of reserves with the Fed. That's why it's called the Federal Reserve System. They're supposed to, it's kind of like premiums on insurance, a small amount. It's not enough anyway. But what they did was they dumped more onto the Fed because they were receiving 0% money in return for buying bonds and giving them back to the Fed and having the Fed overvalue bonds, mortgage bonds they didn't have any opportunity to sell anywhere. And by virtue of doing that, the Fed created an entire cascade of over-evaluation on the stuff that the banks still kept on their books. So some stuff they sent to the Fed that's toxic. Other toxic waste they can't get rid of. But because the Fed bought the first bunch of toxic assets, what they have now in the books, they can mark up to have more value. So they made themselves look more attractive to their shareholders, to analysts and so forth than they otherwise were. And this was a big reason that ultimately they had a sort of stock elevation and still now are trading at sort of triple, quadruple what they were at their lows.
In the book, you talk not just about the economic consequences, but the political consequences. And you say that this process, to use your words, redefined the balance of power in the international order. In the book, you talk about countries like Brazil, Japan. Talk about how it redefined the balance of power.
So what happened in the wake of the financial crisis and the Fed manufacturing all this money and saving a banking system that the entire world knew was at fault for an entire global financial crisis that got exported from the United States outward. This was not news to anyone. This was not publicly unknown. In fact, the central bank leaders in Mexico had warned that this was going to happen beforehand. And in the minute the Federal Reserve came in and started their quantitative easing or their zero interest rate policy and conjuring money to buy all these bonds, the Chinese central bank, the People's Bank of China, started openly criticizing at all sorts of multiple gatherings and conferences of the developing countries, of the BRICS countries, of countries outside the U.S.
I just threw in there that in the book you describe this as this kind of shadowy elite that lives in their own world. I mean, I remember at one point you said they don't even drive their own cars. They are meeting in these incredibly lavish resorts. So, they wield all of this power, and yet it's all hidden essentially from public view.
Right, and again, it's not even they're not even like business people creating a business that makes money and therefore they have it to do this. We actually, sort of pay for a lot of their benefits in terms of the salaries of people at the Federal Reserve and sort of the perks that they get and so forth and all the benefits. So yes, that's another side. In the situation of how the sort of power hierarchy changed is you have these external countries to the sort of United States dollar-based system and what the Fed did and what the Fed had its sort of partners do, the European Central Bank, Bank of Japan, and so forth, and say, look, this isn't sustainable. It doesn't make sense to take a banking system that screwed the world so royally, that's still paying fines on a regular basis, multiple billions of dollars, that hasn't been reformed, that hasn't been restructured, and pay it effectively money to go on and exist, buy their own stock, do whatever has happened since then.
Well, let's just throw that in since you brought it up. They took billions of this money and bought back their own stock.
Yes, I mean, to the tune of, and the Federal Reserve actually has to okay the private bank stock buybacks, and did every single time.
So we're talking about like Citibank, and of course sends their share prices,
yes,
which is touted as our recovery.
Right. So if you're Jamie Dimon, who's the CEO and chairman of J.P. Morgan Chase, and you happen to have been the Class A director on the board of the New York Federal Reserve when this whole bailout and Fed operation was going on to save banks, and you say you didn't need the money, and you say you didn't need the help, but ultimately you have the benefit of getting all of this cheap money, getting rid of any toxic waste you might have, continuing to commit crimes throughout the way, felonies in terms of rigging rates and all sorts of other things that you cop to as an institution. You continue to sit there and clip millions and millions of dollars of compensation, as do the senior members of the institution, because this money has just come in from an external source. So now you go and you buy your stock, and you say to the Fed, like last year, hey, we're all healthy now because we got your money to make us healthy. Can we just buy another $20 billion of our stock? Can we just
throw
buy
some of those figures? You're talking about like $90 billion, or right. I mean, these are massive.
Right, and what's interesting is those figures actually come from the FDIC, or some of the figures in my book, the Federal Deposit Insurance Corporation, which was created in the wake of the Great Depression to secure people's deposits. And they're basically saying, look, we're doing these reports where these banks under our purview, because we secure the deposits of their depositors, are just paying all this money to buy their stock. So now you're sitting there as Jamie Dimon and the people who run these institutions. You're like, okay, I'm getting cheap money in. I'm using it. I plugged the holes, a few years ago. I committed some crimes. I paid some fines. And now I get an all clear from the Fed. This is still in the same 10-year period since the financial crisis. I'm going to go and buy billions and billions of dollars of stock. So, of course, that lifts the stock value of the company. If you buy stock, it goes up. If you buy billions of dollars of stock, it goes up. And so then they can say, yes, we're healthy. Look at how well our share prices are doing.
When we come back, we'll continue our conversation with Nomi Prins, author of Collusion: How Central Bankers Rig the World. Welcome back to On Contact. We continue our conversation with Nomi Prins on the hijacking of the global economy. So, with this infusion of trillions of dollars of what you call fabricated money into the banking system and the financial sector, it unleashed what you call financial warfare. What do you mean by that?
So, the core countries, like the U.S. with its Federal Reserve, the sort of region of the EU with the European Central Bank, the Bank of Japan, and so forth, the Bank of England to a slightly lesser extent, but part of that, were able to collude together at the behest of the Federal Reserve, who said, look, if we're going to be flushing liquidity into our banking system, then you guys have to do it as well, because we're the reserve currency, we're the dollar, people are going to need dollars, so if we're doing what we're doing, you also kind of have to keep up with our policy. So the main central banks in the world that way coordinated a policy of, on average, 0% interest rates for the world. Negative in Europe now.
You had negative interest rates in some countries in Europe.
Some countries in Europe, negative interest rates. Some countries in Japan, negative interest rates, and so forth. And that was done to sort of calibrate the cost of money throughout the world that major countries could have access to, that could plaster over any of the problems in their banking systems, of which the U.S. was the prime culprit. But because they're so independent, banks remain interdependent, and they need to have sort of each other to borrow from, and they group together to execute certain transactions, and they sort of collude together together to rig rates. The whole central bank entities at the core of that were doing the same thing under Fed direction. And so what that caused is a greater amount of inequality economically throughout the world, because other central banks simply couldn't or wouldn't do that because it didn't make sense for their economies, because inflation was too high, for example, in food. If you look at places like Brazil, or because there was just a sort of just inequality coming into the equation, for example, in Europe between the southern European countries, including Greece and in Italy and Spain and so forth, and the core European countries that had more of the benefit from what the European Central Bank was providing in terms of liquidity in that part of the world. So there was choices made. And that's why I considered it a kind of warfare.
Well,
There's
warfare. It became warfare politically.
And
they went after political figures who, like Lula in Brazil, who weren't buying it.
That's right. And even the head of the central bank in Mexico, Guillermo Ortiz, who had warned Bernanke in the beginning of the financial crisis, because he had been in Mexico in high senior positions during the tequila crisis, during 1994, during problems they had had and they had had to get through. And their economy was doing actually quite well before our financial crisis imposed itself upon them. And he said to Bernanke, and this was even covered by the Wall Street Journal, but it really was covered and then forgotten, look, you have to create a confidence from sort of economic bottom of the foundation. You can't just sort of give gifts away to these, paraphrasing, but you can't give gifts away to these banks, because you're not going to ultimately instill confidence in finance, in banking, that you need to actually have a long-term solution to anything. And Bernanke basically dismissed him. Guillermo Ortiz got sort of removed. Well, he didn't get resurrected and reappointed to the head of the central bank in Mexico the next time around. And he started doing the lecture circuit and warning people of the ill will that regulators impose upon the world by not regulating the financial institutions they're supposed to regulate. So that was what happened with his job. And Bernanke ignored him even in Bernanke's memoirs this morning that came from Mexico. So that's the kind of thing that started to shift. Where central banks in some countries couldn't do or wouldn't do the zero interest rate policies of the Fed because it would disrupt their economies by too much. But you have the core countries able to do it, and ultimately that created inequality within the core countries, inequality more so between the core and sort of the developing countries, and then within certain new alliances that were created along the way.
And then you had the call on the banks for programs of austerity, which they used their economic power to impose.
Right, so it technically was not, or is not supposed to be the day job of central banks to promote austerity positions of the government or have opinions publicly on fiscal types of policies. They're supposed to maneuver monetary policy, the cost of money, so as to create a more stable economy, help banks in real times of emergency, not for a decade and not in a monumental way, and sort of watch that inflation doesn't get too high. Now, that's a whole separate other component. What does inflation really mean? Because inflation to actual people, in terms of the cost of what they need on a day-to-day basis relative to wages, has actually increased quite substantially, because wages haven't really gone anywhere. But healthcare costs have, and students' loans are at a record high and so forth for education. Things have increased, but not how we classically, or the central banks and governments classically measure inflation. So that's what central banks are supposed to do as a day job. But what happened in the wake of this financial crisis time period in this last decade is that they started to say, well, look, we need to impose austerity on our country. In fact, the head of the central bank in Brazil under Lula that you mentioned at the time ultimately was not reselected by Dilma Rousseff, who was the president after Lula, to his post. He went into the private sector, which is a sort of corrupt place in Brazil anyway, reemerged as the Minister of Finance right now under Michel Temer's interim government, resigned from that to potentially run for president. And all along the way, he has advocated austerity measures in Brazil.
Why are they advocating austerity? And let's be clear, austerity means cutting benefits, cutting pension payments, eradicating social services, cutting funds for education. Why?
Well, because, and I don't use my subtitle lightly, because those people have rigged the system such that there is money fabricated at the top of it, and it can be used to pump up financial assets, stock, and so forth. And it has to come from somewhere. So what happens is, because money is so cheap throughout the world, there is more borrowing. There's more borrowing at the corporate level. There's more money borrowed at the government level. And where do you get that money back from? At some point, you have to repay it, even though rates are low. At some point, rates either go higher, you have to start getting into the principal of those loans. Somehow that has to be repaid. Where do you go to repay it? Because it wasn't real to begin with. This wasn't money that was made. This was money that was provided. And so you go into the nation, you go into the population, and you say, look, our economy is still unstable. Shocking, because we actually provided all this money to our banking system, and our stock market looks good, but gee, our economy is still unstable. So let's try and extract money from the foundational economy, from social programs, in austerity measures where, we will come in, for example, in Greece, and we'll create a bailout, and for that we'll extract, the sort of values of your ports and
well, you know what they're doing right now
your
in Greece,
ships and all of that.
I just read an article the other day. They've jacked up utility rates to such an extent that even middle-class people can't pay it. And then they're seizing their homes as assets.
And all of that is under this entire program where the European Central Bank has manufactured over $4 trillion, and they're still doing it. This program
Right.
hasn't ended in Europe. It's technically ended in the United States, and it's at a holding pattern. It hasn't ended even in Europe. It is being continued under the ECB head right now, European Central Bank head Mario Draghi. So they are providing money to big corporations, and there's a list of them on the ECB website. You can go in and see exactly who they're providing money for, while they are extracting high utility fees from middle-class people in Greece to repay that debt.
Let me, to close here, you say the issue isn't whether this money conjuring game can continue. It is that central banks have no plan B in the event of another crisis, which you think is inevitable. Explain how it implodes, and the fact that they don't have what you call Plan B, what that will mean.
So all they have done and all they've continued to do is keep rates relatively low. The Fed's raised them a little bit, but again, it's negative in Europe and negative in Japan, so it balances out to zero.
And we should just throw in there, it's a great deal for them, because if you're late on your credit card, you're paying them 16% plus interest.
Right, exactly. One of my readers was telling me the other night that basically they were late on one payment. They went from 12% to 28%.
28 now?
Yeah, and that's in the little print. So if you bother to read the little print, they can do that. There's no limitation on that. And there was no limitation on what these central banks provided to these major banks. But why that becomes a crisis, and a worse crisis than the time before, is because the byproduct of creating cheap money is a lot of borrowing going on. So right now in the world, the level of debt to GDP, to basically what the world produces, is between 2 and 3 times. And that is a historically high level. And that is because borrowing looked cheap. And the same banks at the cornerstone of the crisis that sort of manifested with the central banks this entire activity of fabricating money for them and for the financial system are going about trying to restructure.
So what does the implosion look like?
So the implosion looks like if rates go up a little bit, or those that borrowed, whether it is the sort of more developing countries or whether it's corporations here in those countries, start to not be able to repay their debt. And then they start to not be able to continue to buy their stock. And then the debt market starts to go down. And then the stock market starts to go down. And then they start to fire people because they need to find a way to cut expenses in order to continue to stay afloat. And at this point, the Fed and other central banks have already reduced rates so low that they can't really reuse that process. And they never use that money. They never made banks use that money to help the foundational economy. So we could have done this a whole different way. If you can manufacture, and the current tally today is $21 trillion of money that has bought assets that sits on the books of the major central banks in this world. That is a lot of money that could be used as collateral for loans to actually do stuff, or even in and of itself as cash, where it's collateralized by the assets that they bought and they hold on their books to do a lot of good in the world. And instead, what it's done is it's pumped up markets. So when you start to implode backwards, all of that unravels very quickly.
Just to close, what you're really talking about is a global depression that will dwarf what we saw in 2008.
It has to, because it's going from a higher height.
Right. That was Nomi Prins, author of Collusion, How